you are effectively seeing this policy response for AI, which is becoming inseparable from the demand for sustainable energy. And the punchline is that even without climate policy, there would still be climate investments. Why? Because climate investments ultimately are about reducing costs, saving time, or developing business resilience. These all deliver economic benefits, and these are timeless.
Welcome to WellSaid, where we explore the cyclical and secular forces shaping financial markets and learn how Wellington investors apply investment research in the pursuit of better investment outcomes. I'm your host, Thomas Mucha. The former president of the American Meteorological Society, Dr. J. Marshall Shepard, described weather as your mood and climate change as your personality. Now, as our climate's personality evolves, the weather is getting moodier. Hurricanes are stronger, rainfall totals are higher, heat waves are more intense. And while climate change can't be blamed for every individual storm or natural disaster, the connection between secular shifts in the Earth's climate and extreme weather patterns is scientifically irrefutable. As for the investment angle, technologies that help us adapt or to mitigate the effects of climate change are increasingly seen as technologies that save us money and protect our homes, communities, and as listeners of this podcast know, even and especially national security. Joining me today to discuss the tailwinds driving the climate investment opportunity is Alan Hsu, a longtime climate investor and a portfolio manager of one of Wellington's climate-focused strategies. Alan, welcome back to WellSaid.
Thank you very much, Thomas. It's very nice to be back with you today.
All right, let's start with the big picture, and by that I mean the policy framework here. So policymakers, let's say regardless of their public stance on climate change, are taking action in light of these increasingly dangerous weather extremes we're seeing all around the world. So what and where, Alan, to your mind, are the biggest policy tailwinds for climate technology?
You really are seeing global support from a policy standpoint for what we would consider the climate transition. And you can categorize it as policy or not, is all of the focus on AI that is occurring globally. AI is effectively pulling forward the energy transition because of the immense demand for energy, but also the concurrent focus on sustainability and efficiency, which allows you to grow into that demand in a much more measured, sensible way. You are effectively seeing this policy response for AI, which is becoming inseparable from the demand for sustainable energy. And the punchline is that even without climate policy, there would still be climate investments. Why? Because climate investments ultimately are about reducing costs, saving time, or developing business resilience. These all deliver economic benefits, and these are timeless.
So we're getting a global response. AI is a technology that's powering it, and this is going to happen regardless of the politics, right?
That's right.
All right, well, speaking of politics, what about the U.S.? Can you give our listeners your inside baseball thoughts on the future of the U.S. Inflation Reduction Act, as well as climate technology development in general? And let's say beyond the headlines, in your view, Alan, how is the Trump administration changing the game for renewables, EVs, and other climate solutions, particularly those that got so much attention in the Biden administration?
As usual, there are lots of puts and takes here. So tax credits, as an example, for electric vehicles have largely been reduced, while credits for renewable energy, such as solar and wind, remain relatively strong. There are forms of distributed energy that have gotten support. Again, it's important to emphasize the posture that the current administration is taking on AI. Because they are so focused on winning this idea of this AI race, it has allowed them to become creative and open-minded about exploring all avenues, which ultimately lead to pulling forward the energy transition. So, for example, you are now seeing most countries that care at all about developing an AI advantage or competitive edge discuss forms of energy like nuclear that even 2 or 3 years ago were off the table or verboten. But now almost every major country is exploring everything from nuclear to combinations of technology like solar plus storage, you're exploring a lot of different energy sources that, again, a few years ago you would have not viewed as on the table or even economic. The other aspect that is worth mentioning is that you are also unlocking other pools of capital to explore energy transition technology. You are seeing venture capital go back into climate or sustainable clean energy, whereas a decade and a half ago, the green energy funding that was representative of the mid-2000s was largely viewed as a negative experience, a non-profitable experience. So you're seeing a lot of different pools of capital work to unlock the bottleneck of power and energy. And ultimately, we think that this response from the U.S. as a policy is very favorable for climate legislation.
I tend to look at the climate technology market, like all markets, through a geopolitical lens. It's right there in my title. But as a homeowner who lives in an area prone to flooding, Boston, and is concerned about the future for my daughter, I'm very aware of the practicality and the value of these products. So if these innovations, let's say, lower my insurance rate, my utility bills, if they increase my safety and comfort, I'm all for them. And I assume I'm not alone in this economic view. So how has shifting business and consumer sentiment on climate tech changed your investment approach?
No, Thomas, you aren't alone in this view, and you are hitting upon a very important point, if not perhaps the most important aspect of climate investing that still doesn't get nearly enough attention. Climate investing makes sense because even if you don't care about the weather, the atmosphere, the scientific perspective on warming, climate investments solve real-world problems in tangible ways. Nearly every company in the climate resilience opportunity set, or the companies that we follow and would invest in, offer products or services that either avoid a cost, reduce time to do something, or establish business resilience. And the basic intuition here is that CO2 is a negative externality. It represents the cost of doing business. Every business, every person creates some form of a CO2 footprint just by the virtue of being active. So your business activity generates a series of costs, and CO2 is actually one way to proxy what this cost is. Our research actually finds that companies that are better than their peers on CO2 intensity actually tend to outperform. What's the possible intuition behind that? We think it could be a couple of things, but first would be because better CO2 intensity, meaning you're more efficient in generating revenue per unit of CO2 that you create, it tends to reflect that you're a better run business. You're probably therefore more profitable. And then the second aspect is that it can show superior corporate stewardship. You either have a management team or other stakeholders, boards that are focused on efficiency, that are focused on resource optimization, that are focused on creating the collective benefit of all of the different stakeholders. You mentioned that you're a homeowner. I am as well. And so you should be thrilled by all of the different examples of how climate investments can generate real economic payback. So, for example, home insulation has something like a 2-year payback when it's placed in your attic, maybe a little bit longer if it's put in your wall. Think about smart lighting or LED technology. Think about wood composite decking and siding that is starting to take more share, for example, from vinyl or traditional engineered wood products. Because of the lower total cost of ownership and the ease of maintenance, your payback can be anywhere from 4 to 7 years. Thinking of this from a larger industrial lens, factory automation technology can deliver paybacks of anywhere from half a year to 5 years, while also boosting the safety and the resilience and reducing time it takes to deliver a manufactured good. So these are all technology, and they will continue to be adopted, not only because of the shift in consumer preferences, but because it delivers a real economic payback.
Let's bring this down to the balance sheet a little bit, Alan. And I'm curious, you've mentioned a lot of the factors that are driving interest in the sector. So what company fundamentals matter most in this space?
That's a great question, Thomas. Depending on whether a company meets our investment threshold for climate revenue materiality, we tend to focus on upside versus downside and what we think the path of compounding is for any particular investment. I don't think that myself or our team would categorize ourselves as growth or value-oriented. We think both of those inputs are crucial in determining whether an investment opportunity is attractive or not. I do think that in general, what we tend to look for, the types of ideas that tend to show up on our radar and that excites us, include companies that are operating in healthy industries, meaning there is some amount of discipline within the industry. Supply demand is either favorable or is becoming favorable based on our research. We tend to prefer companies where the ROEs are either very good and we think they can be sustained, or they're okay, but we think that they're going to improve dramatically based on some improvement in end market exposure, some improvement in margin structure. And then with all of that, we try to distill down to a free cash flow metric. We think ultimately cash is king. So if you can value these companies based on what you're getting from a free cash flow perspective, then that is for us an attractive investment opportunity. And then the final aspect of our investment process that I still think explains most of the alpha that is available in public markets actually relates to the reinvestment opportunity. I think what the market often gets wrong, and this is particularly true as it relates to climate, is the very, very long runway of reinvestment that is available to companies that are focused on energy transition, decarbonization, resource efficiency, automation, or adaptation. We think that those areas offer many, many years, if not decades, of problem solving. And so this idea of being able to generate attractive returns on equity over a long period of reinvestment is what excites us, and that tends to be what we look for in our investments.
This problem is not going to be solved over a short-term period.
We don't think so either.
So, Alan, you've mentioned AI a couple of times already. It's clearly an important part of this narrative. Now, a number of industries that were previously ring-fenced as climate solutions may now be major beneficiaries of AI's massive energy demands. So which innovations have the biggest potential runways thanks to this emerging AI revolution?
Thomas, we think AI will end up being much more significant for climate than for nearly any other discrete investment area. If you think very simply, the last 20 years have all been about digital transformation. Hardware went from computers on your desktop to mobile phones in your pocket. Software went from on the mainframe to, again, in the cloud or on your phone. Media went from print to purely digital. That shift has been entirely about digital transformation. But now, because of AI, we think the cost of intelligence, and in some ways the cost of analysis, nearly approaches zero. And so what's left is, what do you do with that intelligence? What do you do with that analysis? And we think that creates a bottleneck or a bid for improving physical goods and services. And this is exactly what climate investing is primarily about. Improving the way physical systems or infrastructure systems, again, food systems, energy, electricity, water, all of these are systems which are collections of assets. With better intelligence, better analysis, we think the next obvious step of what will happen in terms of progress is improving, using that intelligence, using that analysis to improve the way all of those systems are either built, redeployed, reconfigured, or upgraded. We think it will all occur with this emphasis on sustainability and efficiency. So if you look at the world's companies that are focused on upgrading the grid or upgrading transportation systems or renovating or improving buildings, housing, those are the types of companies that we've spent the last 15 years investing in. Those are the companies we think will be the biggest beneficiaries going forward as the digital transformation that we've already seen for the last 20 years makes way to the physical transformation we expect over the next 20 years.
So a massive upside given the potential benefits that AI has across this entire set.
It wouldn't be an understatement to say that I'm a little bit biased, Thomas, but yes.
All right. Now, let's widen the lens a little bit here, Alan, and talk about large markets, including Europe, China, India. You know, they're all shifting their energy mix, of course, towards renewables. It's a complicated process, obviously, involving not just producers and operators, but as you mentioned, grid technology, energy storage, infrastructure. So, Alan, which countries have set themselves up to pull ahead here?
We think if we start with China, they have the greatest likelihood, in my mind, of representing unlimited innovation on energy transition, unlimited innovation on developing all sources of energy. They deploy more solar in a year than we will deploy in several years in the United States, for example. There is an ability in China to create a plan or a vision and execute with ruthless efficiency. There's very little by way of opposing regulation. they can, by mandate, effectively enforce or highly incentivize the development of renewables in all of the different provinces. And the tendency ultimately is to overbuild that capacity. But if you're trying to reduce the cost of energy and drive the marginal cost of electricity and the marginal cost of token production down as much as possible, then I think that overbuild is not only inevitable, but probably a positive in the very long term. But China has vast land. They have vision. They are, if you look at their political leadership, they all tend to be engineers and scientists. That creates a little bit more of this engineering precision focus on how to develop a lot of this economic progress. So I think that China, that is already doing far more in nuclear, far more in coal, far more in renewables than the U.S. does, is going to be well ahead. I think the picture in Europe and India are a little bit grimmer than in the United States. And part of this, I think, is because there is population density and vastly more regulation that gets in the way of progress if you're only trying to optimize or maximize for energy transition. Europe and India, I think, are in a slightly worse position than the United States, which puts the United States effectively in the middle. We have land. We have a lot of innovation. We have significant amount of intelligence as it relates to energy and scientists and people that are very expert in applied technology, but we also have some regulation. I think it will slow our progress in some forms of very, very clean energy like nuclear.
So, Alan, you're veering dangerously into my area of interest here, which is, of course, geopolitics. Mentioning China, of course, as a leader in this area is critical to great power competition and how the policy backdrop is shaping up. In fact, my conversations with the Trump administration and, of course, the Biden administration before that, they were very clear and are very clear about the strategic competition aspect that China represents in renewable technologies in general. So there's a much more strategic view of these technologies given the great power competition context here. So I'm curious for your thoughts about how these geopolitical tensions, which also encompass this global trade war that we're seeing, how are they affecting this market in your view?
Well, Thomas, you're the geopolitical expert. I was hoping to come here and get some advice from you on this question. I try not to have a strong opinion or base any investment decision on my personal geopolitical views. It's not hard if we're just talking about the perspective of the intersection of energy with AI, trade war, et cetera. It's not hard just focus on energy to envision a scenario where our greatest competitor, arguably China, gets so far ahead of us from an energy perspective. Because again, effectively no constraints on what they can achieve from an energy standpoint, that they get so far ahead of us in debottlenecking power limitations, in reducing any friction around access to energy and power, which all of the hyperscalers have described as the largest bottleneck today, that you could begin to see some moves that we take to limit them in other ways. How does that affect our investments, our investment view? That is a little bit of wait and see and take it one day or 1 month at a time. Our posture is the core economics of what are likely to happen. The idea that cost of compute, cost of tokens will continue to come down. Knowledge, the access to unfettered knowledge will continue to go up. But again, difficult to understand exactly how geopolitical tensions play out, but it would not surprise me if the progress that China makes in energy leads to some other type of response from the U.S.
I think you're already starting to see that response, Alan. I think what I'm getting from all of this is that policymakers, this is true in the U.S., but it's also true globally, are scouring industries through this strategic lens, and they're trying to determine, well, which are the industries that we need to control or at least win or compete in this broader great power competition. Clean energy, renewables, energy in general is squarely falling into this bucket. So I think what we're going to see across this whole landscape that you're describing here is an acceleration of protection and promotion of these core strategic industries. And that'll look different across various administrations. The Biden administration was using more incentives. The Trump administration is using more tariffs, right, to try to compel changes in behavior. But my view is that this is likely to accelerate given the national security stakes that are involved here. And I think this is going to be disruptive. But, one of the things that we like to talk about a lot on this podcast is disruption means differentiation. So I do think this is going to create a lot more winners and losers across this space. It also means that you're going to have to be applying more geopolitical analysis to your broader framework. We both sit on the same floor, so you can come and stop by anytime you like.
Thomas, you said it much better than I could have, and as you stated, I largely agree with those views. Another underappreciated tailwind, you can call it policy or not, from a climate perspective, is that as the U.S. and other countries really begin to go through the process of identifying any of the holes in supply chain, any of the vulnerabilities, you will see more and more of this focus on bringing back manufacturing capacity. Post the entrance of China into the World Trade Organization 25 or so years ago, you've effectively seen this significant movement of all manufacturing capacity from the U.S. and other Western European countries over to China. And that has created perhaps some strategic vulnerabilities as it relates to supply chain or essential goods. And I think as you see that come back, and you're already seeing progress there, you've certainly begun to see some announcements there. We do think that need to rebuild that manufacturing capacity. I think it's several tens of trillions in aggregate. If you even brought back a fraction of that to the U.S., well, the need to rebuild some of that manufacturing capacity. But again, with this focus on sustainability or resilience or resource efficiency is another tailwind, whether you call it policy or not, to this idea of climate investing.
Yeah, I do think that resiliency is a key driving factor in all policy going forward. Climate is obviously central to that. The other key driver, Alan, and I want to dig into this a little bit more with you, is national security. And one of the things that I pay a lot of attention to is where climate change is hitting hardest. And that happens to be the equator, all the way around the world, and the tropics, 30 degrees north and south of there. But the way that the Pentagon thinks about that is, well, this is the region where most of the geopolitical hotspots already sit, from North Africa to East Africa, West Africa, the entire Middle East, Iran, Afghanistan, the India-China border, Taiwan Strait, South China Sea. And the Pentagon is quite concerned that these climate changes will lead to more climate migration, more resource wars, more failed states, rising extremism. So there's a big national security push, particularly towards adaptation here, right? Can you make these societies more resilient to rising temperatures, more storms, more floods, food and water scarcity issues? So to me, that's a massive driver. And I'm wondering how you incorporate that into your investment process.
We think that lens into looking at the opportunity set, incorporating either national security informed candidly by perhaps climate science is the term to use, but is an important one to bring up. So as an example to this point, several years ago, based on our partnerships with Woodwell Climate Research Center and our internal climate science team, we were able to identify the very point that you're making, not just that populations are largely centered around the equator, but a lot of the world's global agriculture supply also comes from areas that are plus or minus a couple hundred kilometers or so from the equator. A lot of the world's soy, wheat, corn, beef, vegetables, fruits, etc., nuts come from those geographies. And based on the climate science perspective that we were incorporating into our research, courtesy in some cases of our partnerships, it led to one very stark conclusion, which is that a lot of the world's agriculture was going to become much more at risk and vulnerable to things like natural disasters, the cycle of flooding or drought, etc., that could impair agriculture productivity. And it led us to this conclusion of looking for the types of companies that we think promote agriculture resilience as a form of climate resilience or as an expression of climate resilience. Can you create products, technology, software analysis to become better, more efficient at how you seed, how you water, where you grow your crops? Can it allow you to shift where that agricultural productivity takes place? So this wasn't exactly national security the way that you're describing it, but you could very easily categorize food security as an aspect of security of statehood or people groups, and being able to take a climate science lens to incorporate this notion of security into our investing, we do think is helpful and has led to some perhaps surprising investment opportunities.
Well, there is unfortunately a historical correlation between agricultural disruption, food inflation, and conflict.
Yes.
So you're not wrong in thinking that there is this national security piece to it. And I think that gives even more impetus to invest in these areas. And there's a social benefit here as well as a purely return framework here.
It turns out that resource scarcity really does matter. And to the degree that you identify how that scarcity either gets worse or can be improved, I do think that that can lead to very interesting investment insights.
I'm curious, and I'm wondering if there's a new investment opportunity across EMs that's related specifically to climate adaptation, decarbonization, because again, these are the places that are on the front lines of the climate shifts. Think of India, right? It's squarely in the center of monsoon season. It's got food and water scarcity issues already. You've got geopolitical tensions with China on the northern border given the water situation. So how might climate investing play out across EMs?
So I think a lot of how it will play out is some combination of the current status quo, but also how the political or government leadership, how aggressively they pursue some form of sustainable development. One of the common ingredients to achieving modernity, to modernizing, is the cheap and abundant availability of critical inputs like energy. And I think that as countries are advancing, as they're growing, as they're attempting to modernize, you do see this relatively rapid adoption of those types of inputs with perhaps not as much of a focus initially on the sustainability of those inputs and or developing some of the resilience structure or process or technology that allows that net positive creation of country wealth to be sustained. So what I would expect is for most emerging economies to begin to posture a little bit more decidedly on areas that we would consider sustainable energy or resilience. And I don't think that the products or the technologies for them will look any different than it looks for us in the Western economies or how it's looked in the United States.
It's a demand issue.
It's a demand issue, but it's also a cost-benefit analysis. And I think that this is effectively where the story for emerging market adoption is quite favorable because you've had 20 years of investment in solar by China and by the US. The cost per megawatt hour is much cheaper today than it was back then. It doesn't need to be subsidized to quite the same degree. You can increasingly adopt new applications of technologies that you combine like solar and storage to get interesting use cases today in emerging markets at a much more compelling price point than you would have been able to get even 3, 5, but certainly 15 years ago.
Alan, I could go on for another 3 hours with this conversation, but why don't we end it there? Let me just say that I think we're incredibly lucky to have you at Wellington, and your years of experience here and applying it across this incredibly important topic is fantastic. So thanks again for spending the time with us, and it's been great having you here on WellSaid.
Very gracious of you. Thank you, Thomas. It was a pleasure to be here.
The WellSaid podcast is a Wellington management production. Our producers are Colin Hopkins, Mark Murphy, and Dana Wickstead. Editorial support by Amanda Docherty, Colin Hopkins, and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Animation support from Rasa Sermonte. Production support from Dave Crow. You can listen to WellSaid at wellington.com and at most podcast platforms. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with the legal requirements designed to promote the independence of investment research. It is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.